With our next guest, Pedro Pinto Coelho. He's a chairman of the AFIP, FinTech and InsurTech Portugal, a former chairman of Banco BNI Europa. Pedro has also a lot of experience, more than 25 years in the international financial services, leading blue chip institutions across the globe. He has a value proposition on the FinTech initiative, especially in creating financial products towards that direction. He's an expert in digital banking transformations. So, Pedro, the floor is yours. Please enlighten us with your ideas.
Emilius, thank you very much for the introduction. It's a pleasure to be here. And needless to say that some of the things I'm going to say, it's already been said. So being the last one, it's always a tricky situation, but I hope I can add as much value as possible. I'll try to share my screen now because I think it would be useful to deliver a presentation. Let me see if you can see the presentation now.
Yes.
Yes, right. Okay, very good. So some of the aspects that have been said, I think will be somehow repeated, but I think we're all in agreement that we are talking now about the new environment and what I call the next new normal and the evolving banking landscape. So we're all in agreement that financial institutions are considered by its clients the safest, the safe haven, or I would say the safe posts where clients deposit their money. But the whole model is being questioned. So I would now move, let me see here, to the next page. So I would start by saying that the universal banking model, as you know, it's been a model that has existed for a very long time, not only in Cyprus, but in every single country. There are banks which we have kept an account with that try to provide every single service from retail to SMEs to large corporates. And we see that this universal banking model is being threatened, and this acceleration has increased now with the issue of pandemic and the COVID-19, as people now basically have to deal with financial institutions in a remote way. So I would say, first of all, it's almost impossible for any bank to compete in every segment and be excellent at every single segment. So that's something we have to really consider. The other aspect is that the traditional current account is no longer the anchor for the client. The client can have a current account with a bank and do business with other banks. So the role of the bank as a savings bank, particularly now with the very low, if not negative interest rates, has also eroded a bit the role of the bank as the savings, as keeping the savings for the client, as the client is looking for a yield, and the typical term deposit is not the answer. Again, the other aspect are the credit products. Origination now has been somehow put into question because banks, not only because of regulation, but also because of different networks of brokers and comparison sites, see that origination must be done simultaneously, not only directly, but indirectly. And we see more and more in different markets, the position of the brokers increasing, and obviously the banks have to compete side by side with other propositions, and we even see non-banks competing in certain areas of the credit products. And customers being price sensitive, they will become less and less loyal to the relationship bank. And also, depending on the jurisdiction, you see that you have players like insurance companies, for instance, in the UK or in Holland, providing mortgage products without being a bank. They have an origination platform they cooperate with. They have a servicer entity servicing entity, and then they have the loan on their books. So they effectively don't need a bank, and they have a lower cost of capital than a bank. Now, moving on to the next slide, we see that the fintech cycle is interesting because in the middle 2014, 15, we saw this big boom and fintechs considering that they would be conquering banks, but this has shifted substantially. Now we see more and more banks not necessarily being threatened, but trying to cooperate with fintechs and vice versa. So the first cycle of disruption on confrontation, I think, is already gone. We saw this initial cooperation starting with banks, and the third phase is basically understanding that you have to really be careful in the way you partner with this type of entities, because these entities are startups. They are typically not regulated. Banks are regulated, and they have legacy issues, whether it's from a technology or a human perspective. And you really have to find a way to really embed innovation without slowing down the pace of innovation. So new generation banks have no legacy, but we think the incumbent banks also have to live somehow in this balance between innovation and trying to comply with the regulation and with existing processes. So I would say there will be more and more cooperation, there will be more consolidation, and these neobanks or digital banks, we see that most likely they will probably become new entities or merge with existing entities, and there will be legacy issues that we have to deal with in the future. Because on one hand, you have these new banks that have no clients, that are trying to gather clients. On the other hand, you have incumbent banks that have existing client base that it's worth quite a bit. Now, coming back to the fintech ecosystem, one thing that we really see is now that banks used to rely on the IT departments to deal with suppliers, with vendors, to create solutions adjusted to their needs. Now, we no longer rely exclusively on an IT department. So there should be an innovation department associated with the IT, obviously, that really looks at the fintech ecosystem as a whole, because it is developing fast and in a global way. There might be some regional clusters that are stronger than others depending on the size of the market, but effectively we have fintech companies that typically they can offer from a single technology component to a full stack of products or services. And depending on the case, you may want a partner from a technology or a business perspective. And the number of verticals also has grown fast and has deepened. So we're talking about RegTech, payments, investment apps like robo-advisory apps, big data and analytics, blockchain technology, direct lending, personal finance, PFM. So there is a huge, and banks can get really confused on what to use by when, and they have to really be updated all the time about this new world without being left behind. Because if you start copying some solutions that are already in the market, by the time you reach that level of sophistication where you copied something else is coming to the market, and then you are again behind the curve. Now, in terms of just examples, these are just a few examples that I'm sure banks in Cyprus and elsewhere have already considered adopting. Client onboarding, biometrics. It doesn't make sense for a bank to develop it on its own. There are hundreds of companies that can provide this, and things are evolving fast, and obviously they have to adjust according to the regulation in each country. KYC and AML platforms. We see compliance teams growing very fast, and humans cannot really cope with the amount of information that compliance needs to monitor. So artificial intelligence here plays a role, and very sophisticated platforms help banks dealing with this flow of transactions to guarantee that you have a seamless approach and you really are able to pinpoint where the problems or the alerts may be. Payment platforms, FX platforms, we see again niche players being more competitive than the banks on the remittances play, and we see now players like TransferWise partnering with banks because they know that they can offer a better product than they have themselves. Robo-advisors, as I mentioned before, simplify the way of investing and doing passive investor for investor at a fraction of the cost of private banks. Credit scoring, benefiting from larger amounts of data which the bank can benefit. Servicing or NPL management is another area, and origination platforms are others that are becoming more and more sophisticated. Then, in terms of differentiation, as we said, if the universal banking model is dead, then we really need to think hard how banks can differentiate themselves. And obviously, the smaller the market is, the more important this may be, because you need to go beyond borders, hopefully in the European Union, to really come out with a strategy where you can eventually offer a service or a product or a set of services or products that can really help any client anywhere, and the strategy in each geography might be different due to the cultural differences. And we also see that the full online world, it's not enough for the client. So the online and the offline need to merge, and banks will have a role there because they are used to do much more offline than they used to do digitally, and now they are moving completely the pendulum to the online world. But I would say the balance is the key, because in certain segments you may need to do something offline, in other segments you may be able to do it fully digital. But depending on what you're selling, you really need to guarantee that those channels are used to the benefit of the client. And then finally, what could be as a benefit for the banks? To partner with businesses, and as we have said here before, to verticalize the business and be the engine of the financial services in a particular industry. Here I'm just giving some examples like retailers, airlines, automotive industries. So we find more and more examples, and the regulators also need to understand this, because sometimes it's a bit hard where the regulation starts and where it stops. We see elsewhere around in Southeast Asia, for instance, apps like Grab, a taxi app, being embedded into financial services. And I think in Europe, we will soon see more and more of this happening.